Hi there, welcome to our financial education channel. This is our second lesson on the beginner guide to Forex trading. In this video, we're going to learn about the terms used in the Forex market. As every trader should know, each market has its own language. That's the same thing in life also. If you're going to Russia or Germany, you need to familiarize yourself with their language or something. It just makes the whole thing easier. Wasting no time, let's break down the Forex terms. The first Forex terms that we're going to discuss are currency pairs and the bid or ask price. A currency pair is defined as the quotation of two different currencies, with the value of one currency being quoted against the other. The first listed currency is called the best currency, and the second currency is called the quote currency. An example will be Euro to USD. Euro in this case will be the best currency, and then the US dollar will be the quote currency. Currency pairs are quoted based on their bid price and ask price. The bid price is the price that the forex broker will buy the best currency from you in exchange for the quote currency. The ask is the price that the broker will sell you the best currency in exchange for the quote currency. Bring us to the types of currency pairs. There are many types of currency pairs. The total number of currencies that exist changes as currencies come and go. All currency pairs are categorized according to the volume that is traded on a daily basis for a pair. The currencies that trade the most volume against the US dollar are reflected as the major currencies. These include Euro USD, USD to Japanese yen, Great Britain pound to US dollar to Swiss franc, Australian dollar to US dollar, and US dollar to Canadian dollar. The major currency pairs tend to have the most liquid and attract the majority of traders in the market. In general, from Monday to Thursday, that's when we expect to have the highest volumes being traded, since the market closes on Friday 5 p.m. and then opens on Sunday night. The other type of currency pairs are called minors and exotic pairs. Currency pairs that are not associated with the US dollar are referred to as minor currencies. Minor currencies tend to have low volume being traded as compared to major currency pairs. Furthermore, minor currency pairs that trade the most volume usually have an individual currency pair that is also a major. For example, Euro to Great Britain pound, the pound to Japanese yen, and Euro to Swiss franc. However, in the case of exotic currency pairs, these include currencies from emerging markets. These pairs are not as liquid, and the spread tends to be wider as compared to the other currency pairs. A spread is the difference between a forex broker's sell rate and buy rate when trading currencies with them. For instance, the price for Euro USD might be €1, could be buying $1 25.67 cents. Adding the spread, the price will end up being $1 25 cents 87, including the spread. Yeah. Bringing us to our next forex terms, pip and lot sizes. A pip is defined as the smallest whole unit price move that an exchange rate can make based on the forex market conversion. Most currency pairs are priced out to 4 decimal places, and a single pip is the last digit or the 4th decimal place. Thus, a pip is equivalent to 1/100 of 1%. For instance, the smallest whole unit move the US dollar to the Canadian dollar pair can make is 0.001, or what is known as 1 basis. Currency pairs are quoted in terms of pips. The value of a pip depends on the currency pair and the exchange rate and the value of the trade. Let's say your Forex account is funded in US dollars. If you want to trade Euro to USD in this case, since the US dollar is the second pair, or what is known as the core currency, the value of our pip is fixed at 0,0001. If the euro increases, let's say with 10 pips, we multiply 10 pips by 0.001 to find the value of 10 pips. Bringing us to what is known as lot sizes. In Forex market, the three known lot sizes, which is the standard lot, which is equivalent to 100,000 units of the best currency if you want to trade. As highlighted on the table, this will help you understand easily what lot sizes are. Bringing us to our last forex term, leverage and margin. Leverage is the use of borrowed money to invest in a currency. By borrowing money from a broker, investors or traders can trade larger positions in a currency. As a result, leverage magnifies the returns from the favorite movements in a currency exchange rate. However, leverage is a double-edged sword, meaning it can also magnify your losses. Thus, it is important for a forex trader to learn how to manage leverage and employ risk management strategies before trading. Another thing to note is trading using leverage is not free. Thus, the broker requires you to put down money upfront, known as margin. Let's say the exchange rate for US dollar to Aussie Australian dollar is at $1 is buying 68 cents of Australian dollars. As a trader, you want to buy a lot size of 0,01. The broker may require you to put up front 68 cents in order to place the trade. That is what we're talking about, the margin. Furthermore, another thing to note is that margin varies depending on the broker that you're using. So that's another thing to take note of. The types of leverage ratio include 1 is to 50, 1 is to 100, and 1 is to 200. Let's say you're a trader, you want to buy 100,000 worth of euro to USD pair. The broker might require you to hold $1,000 in the account as margin, given your leverage ratio is at 1 is to 100. So 1,000 times 100, that's 100,000. So that's how you'll be able to use the leverage to buy 100,000 worth of euros. Another relevant example of 1 is to 100 leverage ratio could be, let's say, let's take it to a smaller scale. Let's say you want to buy or you want to place a trade worth the value of $1,000. The smallest amount of margin a broker might require you is $10, given you're using 1 is to 100. So that's how margin and leverage work. Lastly, one thing to be aware of is that forex brokers have to manage risk, and in doing so may increase a trader's margin requirement or reduce the leverage ratio. Ultimately, the position size sometimes. So that's another thing to take note. So this is the end of our second lesson. If you have any questions, you can post in the comment section. Thank you for watching and hope you have a successful trading journey.